Hello everyone, this is Tyler and you're listening to the Market SitRep, Tech Shenanigans. So let's dive right in, starting with a macro update. The dollar rally is definitely on hold for now. It's going to remain range bound and consolidate until the big central bank meetings in mid-March. You can see here, after the big run up in 2014, we continually be range bound, sitting in the middle of the range right now. Don't expect much to happen on either side of this range until we get the central banks making big moves. Now, post mid-March meetings, we think USD will start to rally due to increasing monetary policy divergence. The fact of the matter is, the U.S. is the best house on a bad block. The BOJ and ECB will be forced to go nuclear to promote inflation in their countries. They got nothing going for them right now. So Japan's already tried negative interest rates, but it's not working. And as I said earlier, outside the U.S., current monetary policy is just not proving to be effective. So here's a good graph of USD JPY. We could see that NERP announcement came out, and instead of the yen weakening, it went to 52-week lows. And when this chart goes to 52-week lows, that means that the yen is strengthening in comparison to the USD. So the market did not react well to Kuroda-san's NERP announcement. Additionally, there are $6 trillion in global bonds now trading at negative yields, and people are still not acting. So despite the fact that you buy these bonds and get paid less for them at maturity, it's not causing people to act and put it elsewhere. So Kuroda-san and Draghi have problems. And this is a lot different from the U.S., where the latest CPI numbers that came out surprised big to the upside. So we actually have inflation over here, and the latest number is at a 15-month high at 1.4%. So NERP is off the table for the U.S. with that inflation print. We think that a number like this raises the likelihood of the Fed raising rates next month, and that's going to exacerbate this monetary policy divergence play between the U.S. and the rest of the world, and the dollar's going to go parabolic off of this. So once the dollar greenback gets going, it's going to force devaluation on row, and it's going to create a large deflationary feedback loop. This is going to cause commodities to get crushed even more, including oil and gold. And we've been very, very vocal lately about how this gold rally is probably a bull trap, because we don't see it continuing in the strength of extremely strong dollar bull market. Now moving on past macro into tech, we can see here a Puking Unicorn. That's exactly what's happening in the tech space right now. All these overvalued companies that make no money are starting to feel the pain. Now, one of these called Zenefits, and Zenefits is a private company, but there's a lot of good takeaways we can use to apply to public companies. So anyway, Zenefits is a HR startup, and it makes software for small businesses. So the company primarily makes money by acting as a health insurance brokerage firm for its customers. Strong early growth led to hefty promises of future growth, and big-name VCs piled in, including Andreessen Horowitz. Zenefits began hiring people who had little experience with software sales in a highly regulated industry, which was health insurance. And to sustain this growth, they went on an insane hiring spree, hiring as much as 100 people in a single day. And overall headcount grew to a reported 1,600 late last year from 15 at the end of 2013. Growth of that magnitude is insane to me. 15 people is 1,600 in 2 years. And in classic startup fashion, there's a lot of partying going on. They had a keg in the Arizona office. People were drinking during work. And these startups do these kind of things to attract people to join a company that can't necessarily pay them out right now with a large salary. So employees were told to turn their work shirts inside out when they went to the bars in Scottsdale, even, so they didn't reflect bad in the company. So the entire culture started to degrade, and people were treating it more as a party space than a workspace. And this is a very real anecdote. I myself have been to many of the startups offices in Austin, and I could see the kegs on the wall. I could see the taps. They're drinking by 3 p.m., leaving the office early, and basically partying. It's more of like a frat house than a company. So Zenefits moved beyond small businesses to large customers with hundreds of employees, and the software started to break down. It couldn't keep up with these large customers that had hundreds of employees. Instead of pausing to fight fires, though, and fix bugs, they simply just hired more employees to fill in where the software failed, and they even used product managers for manual data entry. And the trouble was obvious, but leadership couldn't even afford to stop and take a breath to fix the problems. So growth was just the only focus at the expense of everything. They didn't care about nothing, not a single thing, unless they were growing. So despite the hordes of new workers, and employees still felt very strained and had felt like they had way too much to do. And then pay became a problem, and people were given low salaries with the promise of increases when funding came through. But Zenefits didn't make good on these promises while it raised new investments. So eventually they couldn't keep up with their revenue promises, and things started tumbling down. So for all its training, Zenefits began to fall short of revenue goals, and one insider even reported that by late 2015, recurring revenues were around $70 million, not the $100 million the company had projected. And the write-offs began. So last fall, Fidelity Investments, who invested in Zenefits, marked down its stake in the company by half. So Zenefits is just a perfect example of what we're seeing in this latest tech bubble. There'll be a lot more companies like Zenefits brought into the light soon. And an interesting anecdote, I talked to an Austin commercial real estate broker, and he was saying that the only companies affording the exorbitant downtown rents are those backed by hot VC money. And this again just supports the fact that these companies are buying the hot and flashy thing to attract people to the company to get to grow as fast as possible without focusing on bottom line or cash flow. All the companies with cash flow are moving out. So they're going away from downtown into more north and south, whereas the hot money VCs are paying the huge rents in the city here in Austin. So these ridiculous valuations assigned to these businesses created unrealistic expectations, which has now led to shoddy business practices that we're seeing in Zenefits. And there's a lot of fuzzy accounting going on in this industry in general. Crappy businesses are receiving sky-high valuations that make no money. And we believe there's been billions wasted in misallocated capital in this recent run-up in tech, most notably the SaaS industry, software as a service. So to paraphrase Buffett, when the tide goes out, you can see who wasn't wearing pants. And let me tell you something, in the tech sector, a lot of people are not wearing pants. So on the public side, though, how can we play this? Well, Workday actually looks very attractive to the short side. And if you're not familiar, Workday is an application software business that provides human resource services. So the same type of unsustainable business model that was built at Workday, that was built at companies like Zenefits. They use the easy money environment and investors' love for cloud companies to buy growth, meaning they used easy money to pay for everything. They would just issue more and more shares when they ran out of cash to raise even more. And that money would go to fuel ridiculous sales and marketing and R&D expenses. And so spending in these areas is what propelled their strong growth that investors wanted. So they bought growth rather than earned growth. These sky-high sales and marketing expenses, they actually accounted for 30% of total revenue. R&D was 41%. So together, you're sitting on, almost nearly 80% of revenue. And that's insane to spend almost 80% of your revenue on R&D and sales and marketing. And so they have this growth, but they still have never made profits, and they've only lost money, and their EPS is actually starting to get worse now. So investors have been ignoring that and keeping their eyes on growth. And you get the same high expectations like you did with Zenefits, one that's all investors focus on is growth and not bottom line. But to keep up with these expectations, they need to keep buying more and more growth, and this business model becomes unsustainable because it only works when the stock price is going up. So as soon as the price turns around, the easy money stops because Workday can issue more shares to buy their growth, and then the whole business model collapses on itself, and that's what we're seeing now as the price drops. And it's dropped quite dramatically in the last few weeks here. We've been short Workday since around January 28th, and the current retrace is pretty normal. We're looking to add to our position as well as it resumes its downtrend. We feel like it has a very, very long way to drop. Then move on to another bearish theme. Because we see some macro headwinds and the economy starting to turn, bearish staffers is quite intriguing. So in January, a total of 75,100 layoffs were announced. That's a number not seen since January of 2009. And on a year-over-year basis, layoff announcements are up 41%. And these are numbers you're not going to hear in mainstream media. They talk about low unemployment, but numbers like these are sort of alarming. So we're looking into staffers on the short side. What's holding us up right now is the fact that in our HQ, things are still looking pretty strong in Austin for jobs and staffing. But we have to investigate further. Here are some picks of staffing companies that look pretty bad at the moment. So we got Manpower Group riding on that support, not looking that great. Robert Half, and this thing sure as hell wasn't feeling the latest jobs report. Look at the huge drop it's had since last March. Kforce Incorporated, blowing through that support line, not looking good. And finally, True Blue Incorporated, looking like it's about to break that support line there. So none of these staffing companies look that great. Chart looks pretty sick, especially in TBI and actionable here on that break of that support line. And before we wrap it up here, I want to talk about the E-mini S&P 500 futures. We trade these to get exposure to the broad market in the U.S. As you can see, we've held the support area down in the 1820 range since all the way back to October 2014. And we've been testing it again. We did not close below this line, and we've ripped out of it. So at this point, we're kind of in a wait and see moment in the markets. This could hold, although we doubt it. We think the market will actually move higher in the short term to around 1980 area and retrace most of this rally here. And then right in this zone is going to be a good spot to try to pick a short, because we think after mid-March central bank announcements, those could catalyze the market lower again, and we'll eventually retest the support down at 1820. And at this test, it's probable that we'd break that and probably fall all the way to 1600. So if you guys want to try to get short, look for this area to sell and add on a break of the 1820 range here. Thanks for tuning in this week to the Market SitRep. I hope you enjoyed it. If you liked it, subscribe to our YouTube channel or visit us on StockTwits, Facebook, or Twitter at Foundation Alpha. Our Facebook group is particularly intriguing because we get to talk about investments and what we're doing in real time with members there. It's a free group. Just got to click to join it. And if you want to check out our site, it's foundationinvesting.com. Once again, thanks for listening, and I'll see you soon.